Over the last few months, I've had a few people ask me the same question. What's your actual investing strategy? Not the theory, not the general advice, but what is exactly what my wife and I are doing with our money in 2026. So in this video, I'm going to walk you through my full system, all of the ETFs we invest in, how we balance growth and income, how we use our mortgage offset accounts, how we use salary sacrifice into super to reduce tax. Just a small caveat, none of this is financial advice. It's simply the strategy that works for us right now as two people in our mid-20s trying to build long-term financial freedom. Before getting into the specific investments, it's important to understand the big picture strategy. Our goal with this strategy is very simple: to build multiple layers of financial security so we can take steps towards achieving the ability to be part-time or possibly work optional by the time we hit 40 years old. Now, what do those layers of financial security actually look like? Number one, we invest our money in a few different ways. We are invested into the stock market, superannuation or retirement investing. We pay down our mortgage as fast as we can. And while doing all of this, we try to maintain strong cash reserves. We don't try to chase the next hot stock or constantly change strategies. We focus on consistency and simplicity because boring strategies tend to work best over long periods of time. So first, let's break down our ETF strategy. And the way that I've built my shares portfolio, my strategy is very simply broken up into two columns: the international ETF column and the Australian ETF column. So first, let's talk about our international ETF strategy and how it is growth focused. This is where the majority of our long-term growth is expected to come from. We invest in 3 different ETFs in this international side: QQQM, VOO, and VEU. Each one plays a slightly different role. And if you're new to the world of stock investing and all of these different ticker symbols, I'll give a brief description on each ETF I invest in and why. QQQM is our primary growth engine. It's the largest position in our international portfolio, and that is by design. QQQM is an ETF that tracks the NASDAQ 100, which includes many of the largest technology and growth companies in the world. Its top holdings are companies like Apple, Microsoft, Amazon, Nvidia, and Google. These companies have been some of the biggest drivers of the stock market growth over the last decade. Now, I'm fully aware that this makes our portfolio a bit more growth focused and slightly more volatile, but because we are still young and investing for the long term, I'm comfortable taking on that extra volatility. The second international ETF that we hold is VOO. A very well-known ETF, VOO tracks the S&P 500, which represents roughly the 500 largest publicly traded companies in the United States. This gives us broad exposure to the overall US economy. So instead of trying to pick individual companies, we simply own a small piece of hundreds of them at once. Because I've got to be honest, between working full-time as a nurse and doing everything that I need to do for this YouTube channel, plus having a life outside of that, I do not have time to sit down and look at cash positions on companies and read through their spreadsheets. VOO acts as a core holding in our portfolio, and it diversifies my money into all of the top companies in the US. And although it does double dip into some of those tech companies that are included in QQQM, it helps balance out my money into a lot of different sectors in the US market. My third and final international ETF is our holding in VEU. VEU invests in companies outside of the US. This includes markets like Europe, Japan, Australia, and some emerging markets like China and Vietnam. The reason I include this ETF is simple. While the US has performed extremely well historically, I don't want to hold all of our investments concentrated into a single country. So VEU helps diversify our portfolio globally, therefore spreading out our risk. Now let's move on to our Australian stock portfolio. While our international portfolio focuses on growth, our Australian portfolio is built more around income and dividends. The 3 ETFs we invest in: VHY, INCM, and IHD. These funds focus on high dividend paying Australian companies. Why dividend ETFs? One of the big advantages of Australian dividend stocks is something called franking credits. And without getting too technical, franking credits reduce the tax you pay on dividend income because the company has already paid corporate tax on those profits. So when ETFs distribute more income, a portion of that income is more tax efficient. And for long-term investors, that can make a pretty meaningful difference. So to break the funds down, the first one is VHY. It focuses on Australian companies with strong dividend yields. Companies in this ETF often include large Australian businesses like banks, mining companies, and major infrastructure companies. These businesses tend to be mature, stable, and profitable, which make them reliable dividend players. And for INCM and IHD, they both follow similar strategies. I hold all 3 because they all generate income in a slightly different way. VHY focuses on large Australian companies that pay strong and mostly fully franked dividends, so it acts as my core dividend ETF. IHD also also targets high dividend companies, but it uses a different selection method and sometimes includes slightly smaller or higher yield stocks. And then INCM, it's a bit different again because it includes other income producing assets like REITs and hybrids. So it's more diversified and not just relying on banks and miners. Holding all three helps me build an Australian income side of my portfolio without just depending on one single strategy. So that's basically it. Our Australian portfolio acts as our cash flow generator, while our international portfolio focuses on more long-term growth. Now let's move on to something completely different. Let's talk about our mortgage strategy. This still plays a massive role in our overall financial plan. Right now, we put an extra $200 per week into our offset account, and that is on top of our regular mortgage payments. And if you're not familiar with how an offset account works, the money sitting in that account reduces the amount of interest charged to your mortgage. So for example, if you have a $500,000 mortgage, but you have $50,000 of savings sitting in your offset account, you're only paying interest on $450,000. This makes the offset account a very low risk way to effectively earn the same return as your mortgage interest rate. And because the mortgage rates are fairly high at the moment, this strategy makes a heap of sense to us. We also regularly move extra cash into the offset account at the end of each month. And that's pretty much whenever we notice there's a little bit of extra money sitting in there than intended. But at minimum, we're putting an extra $200 per week or $800 per month into that offset account. And that is extra on top of what our usual mortgage repayments would be. So the offset account does a number of things. It acts as an interest reduction tool, our cash reserve where we hold our main emergency fund, and part of our overall wealth strategy. And moving on to the final piece of our strategy is our superannuation or our retirement accounts. Because we're here in Australia, super is one of the most tax efficient ways to invest for retirement. Both my wife and I contribute additional pre-tax money into our super through something we call salary sacrifice. The reason we do this is because contributions into your super are typically taxed at 15%, which is often lower than the marginal tax rate. So effectively, we're able to invest money for our retirement while paying less tax on it. Over long periods of time, those tax savings can compound into some pretty significant advantages. And inside of our super accounts, the money is invested into high growth index funds. So it continues to compound over time, just like our stock accounts, but any compounding gains that we make inside our super accounts are taxed at a highly efficient rate. I myself have 100% of our super allocated to QSuper's high growth index. And Sophie has all of her super allocated to their balanced fund. That's just the level of risk that she is comfortable with. So if you're here in Australia and you haven't had a proper look at your super, a few things to do to make sure that your super is trending in the right direction is one, take any advantages that your employer is offering. Ask your employer about any contribution matching or any superannuation programs that they offer and take full advantage while you can. The earlier you do this, the better. Two is to look at where your superannuation is actually allocated. So usually you have to log on to your super account on a web browser. And if you're happy with their allocation, leave as is, or just change accordingly depending on what your preferences are. And my third and final tip is to get it set up on your phone so that you can check it regularly and track its progress over time. If you find out that your super is underperforming compared to other superannuation funds out there, it's a very easy switch and it's something that can make you a lot of money by the time you hit retirement age. So if we take a step back and look at the full system, it's all actually very, very simple. We invest in growth ETFs internationally, dividend ETFs here in Australia because of franking credits that are available. We aggressively reduce the amount of interest through our offset account, and we invest tax efficiently through superannuation. So there's no complicated trading strategy. There's no staying up all hours of the night to pick stocks. No trying to time the market, just consistent investing into diversified funds. Now, if you've made it this far, you are lucky because you are the few that get to hear me say the biggest thing that you can do for your finances is continually being committed to learning and your own financial knowledge. Because this is our strategy now, but it will probably evolve over time depending on how the world looks and how well we stay informed. As we get older, we may shift towards more income producing assets, or we may pay off our mortgage more aggressively. But as of right now, this is the strategy that we believe gives us the best balance between growth, income, tax efficiency, and financial stability. And for two people in their 20s trying to build long-term wealth, that feels like a pretty solid place to start. But I know for a fact that it's not where we're going to finish. I'd love to know your thoughts. Do you prefer growth investing, dividend investing, a mix of both? Let me know down in the comments. Give me all of your arguments, all of your answers, because let's learn off each other. The more ideas we can bounce between each other, the more informed we will all be as investors, and that itself will pay dividends for our pockets. And if you enjoy seeing transparent, personal finance content like this, make sure you hit subscribe because I share our monthly net worth updates, investing strategies, and everything we're learning along the way. Thanks for watching. And as always, I wish you all the best on your wealth building journey. Hey guys, if you enjoyed that video, you should click here. No, because YouTube thinks you'll like this video. You should click it. No, but seriously. Come on, why haven't you clicked it yet?